Bloomberg Audio Studios. Podcasts, radio, news.
Joining us in the last 48 hours, the great bull market pinata, Edward Yardeni joins us of Yardeni Research. How have the last 48 hours been when I believe you just shifted probabilities
absolutely.
Of your roaring thesis?
Well,
how's it been?
I got to be a bit of a realist given what is going on. I'm still sticking with 60% for what I call the roaring 2020s. However, I had given 20% to a melt-up because things kind of had that potential still. It's not a high probability. And 20% to a meltdown or recession.
Right.
Kind of a bucket for everything that could go wrong. Well, now I'm just 5% for a melt-up. That's very unlikely. And 35% for things going wrong, which they are.
Amazon does a $37 to $42 billion bond offering. Damien tells me it's going to be 6 phone calls. Heath Terry, brilliant, over at Citigroup, publishes and reaffirms AI viability in revenue, in profit, in getting things done with all this.
I agree with that.
CapEx. Synthesize in, as you mentioned, spreads haven't moved. The bond market's screaming stability. These other news items, fold them into your roaring 20s theme.
Well, I mean, we've done pretty well with that thesis so far. We've got a few more years here left in the decade. I think this will pass.
You're short selling yourself. Folks, it's the Yardeni Ancampora low of October a few years ago. Ed and Ralph Ancampora, they nailed it. Continue.
Thank you very much. So look, I think in the short term we clearly have an issue with the Strait of Hormuz. It's hard to get optimistic here unless we see some tankers actually going through there without any incident. I know the president sounds like he wants to declare victory here pretty shortly, but I think Iran lost the war. They just don't really know it, and they're not acting like it. The problem with this country is that it's a terrorist state with a terrorist organization that basically spreads terrorism around the world, and they're professional terrorists, and so it's very hard to kind of beat them just by blasting them with bombs.
Ed, back in December, you correctly, I'm going to give Ed a softball here. He correctly called for an underweight position in the Mag 7, and the basket's now down 6.3% year to date. I'm curious, do you see further weakness in U.S. tech stocks right here, right now, or is this a buying opportunity?
Well, I think it's becoming very bifurcated. The companies that still have moats, the companies that are basically competing in still fairly stable marketplaces, I think are fine. The problem for the Magnificent Seven is that they used to be kind of like the Game of Thrones. It was like 7 independent kingdoms that had moats and didn't really bother each other. But ever since AI, they're competing like mad, and it's an AI arms race.
We're going to continue with Ed Yardeni, Dr. Yardeni of Yardeni Research. Can't say enough about his research. It's an exceptionally valued Yardeni report that you get from him literally on a daily basis. Damien Sassar and Tom Keene with Ed Yardeni. We'll move forward here in a bit to further discussion of what we saw in the Secretary of Defense's press conference here a bit ago, but it is about the markets. Here's the summary for those of you across this nation waking up. The VIX was 35. That is painful. We've come in dramatically to a 24.57 with red and green on the screen, but a decidedly better tape today than what we witnessed in the last 48 hours. With the market opening, Alexis Christoforous.
All right, thanks very much, Tom. And investors continuing to try to assess how long this war with Iran will go on and what its global impact will be, especially on the oil markets. So we have a mixed start here to the morning. The S&P 500 down 3 points at 67.93. Dow Jones Industrial Average down about 25 points, but the NASDAQ in the green right now by about 42 points. The Russell 2000 is down just fractionally. We've got Brent crude at 91 $81.44 the barrel, down 7.5%. WTI crude down about to 7% now to $88.04 the barrel, and the Bloomberg Dollar Spot Index at 1197.84. Spot gold, by the way, bouncing back up 1.5% at 52.15 the ounce. And Amazon returning to the bond market, selling the debt in as many as 11 tranches ranging from 2 to 50 years. It's the latest in a series of jumbo bond sales by hyperscalers as they gear up to invest in what else but AI. That's your Bloomberg Opening Bell Report. Tom and Damian.
Alexis, thank you so much. Again, red and green in the screen, NASDAQ with a little bit of a bid, 24.25 on the VIX. Ed Yardeni with us, always associated with Professor Tobin at Yale. But before that, high above Cayuga's waters at Cornell University. Ezra Prasad is one of the great optimists of international economics. His new book, out of Cornell, is The Doom Loop on the economic order. He even gets Game of Thrones into the first chapters. He's got Cersei doing an economics. Right. You, more than anyone I know, Ed, pushes against the concept of a doom loop. What do you say to the people that feel the gloom, feel the doom?
Well, there are a fair amount of perma bears out there, and a lot of people listen to the perma bears. And the perma bears very often sound very logical. The problem is they don't provide a balance. And perma bears will get you out at the top of the stock market. They'll get you out in the middle. They'll get you out at the bottom. You'll never be in the stock market if you'd have a pessimistic attitude. Also, politics sometimes gets in the way of clear-headed investing. The market tends to go up as long as earnings are going up, as long as the economy is doing well. And that's been the case for a long, long time. So I have this view that corrections and bear markets are buying opportunities rather than reasons to panic.
Well, Ed, you talk about the economy doing well, and in all seriousness, does economic data even matter at this point? I mean, look at last week's payrolls. I mean, the markets look straight through that for like 3 seconds, and then tomorrow we're going to get a CPI print that, by definition, after the last week's events, is already stale. Yeah. So, talk to us a little bit about the economic touch points that you're going to be most focused on here.
Well, look, I think that the economy still matters because earnings still matters. I used to be just an economist. I'm also a strategist, and being a strategist is a lot easier. All you got to do is forecast PE times E, and that's very easy to do. Getting it right, of course, is the challenge, but it's still those two variables. And the earnings outlook, I think, remains quite strong because I think the economy will remain resilient. I mean, in 2022, we had an oil price shock, and the economy made through it just fine. I think the data that the stock market is looking at is not just the employment numbers, but they're looking at the productivity numbers. And that's really the bullish story, is that productivity is making a huge comeback.
Well, Ed, we began our conversation, Tom mentioning that you had upped your probability for a market meltdown from 20 to 35% for the balance of this year.
Yeah.
And, my question is this, when I think of meltdown, I think of something on the order of a systemic liquidity shock. And this is a different sort of shock than we witnessed in 2000 and another, kind of what funding and financing metrics are you most focused on here? Like, what kind of a liquidity shock do you think can happen?
Well, clearly, when you look at history, you find that more often than not, it's a shock in the credit system that causes problems for the stock market. You get a financial crisis because the Fed tightens, something blows up, and that becomes a credit crunch. It's credit crunches that cause recessions. Right. This time around, I think we have to remember that the Fed's awfully good at playing whack-a-mole in the credit markets. As soon as something blows up, they move in pretty quickly. March 2023, we had a banking crisis. It was only 3 banks, so it was solved over the weekend.
Yeah.
I got 15 ways to go here, but let me just go to the experience. I mentioned earlier this modest drawdown we had in 1987. In my memory, I don't have it in front of me, folks, is what a rebound from October 27th to the end of the year, December of 1987. I remember the sweat in August of 1998. And off we went to the races in 99.
Yeah.
What's different now in tech versus the collapse of March of 2001?
Earnings. We had a lot of dot-coms back then that weren't making any money. We had a lot of telecom companies that were seller financing, so they're kind of creating their own magic. Until these companies, these Mag 7s started to kind of finance each other. We didn't really have that issue. But they're huge cash generators. I think their expenditures are going to prove to be very profitable. So I'm not particularly worried about the earnings side of the tech story.
It's part of the show this morning, commercial-free, the conversation too important. Ed Yardeni, Dina Esfandari coming on here in a moment. Damian Sassar and Tom Keene with Alexis Christoforous and Michael Barr across this nation on YouTube. What a couple days on YouTube. Thank you so much for this new digital distribution. I can't say enough about it. Subscribe at Bloomberg Podcasts for all that we do here in the New York morning. Damian Sassar with Ed Yardeni.
So, Ed, we talk about the Roaring Twenties theme. We talk about, the potential for a market meltdown, a market melt up. Talk to me about your stagflationary 1970s redux theme. Redux.
Yeah.
If you're in EM, it's redux or whatever you say. We call that redux.
No, I mean the stagflationary. That word's coming back. So, talk to us a little bit about what you're seeing there.
Yeah, there is a certain amount of deja vu all over again. Every time we've had oil shocks in the past, we've typically gotten recessions and bear markets. The one near-term exception was what happened in 2022. We got a bear market, but we didn't get a recession. I don't think we're going to get a recession this time, though recessionary expectations have gone up. But the U.S. is much less energy intensive. And by the way, we're an exporter of oil and gas, which is a huge difference from what happened in the 1970s. On the other hand, shutting the Strait of Hormuz is a radically different historical development that just hasn't happened before. And so my short-term caution, bearishness is totally predicated on this geopolitical development. I want to see some tankers get through the strait without getting shot at.
Well, I mean, you just mentioned that, and that's where I was going to go. I mean, Gulf traffic is basically all for naught, right? I mean, there's nothing going through. And, we just saw last week U.S. Treasury Secretary, Scott Bessent basically slamming, JP Morgan for putting out research about maritime insurance and things of that nature. How focused are you on some of those alternative data sets, kind of trying to gauge out, whether or not shipping, companies even want to, pass through the Strait of Hormuz now and insurers want to back it? I mean, who knows?
It's funny you asked that. One of the reasons I'm very positive on AI is because we're using it all the time, and we've become real fans of Claude. And so Claude is in our staff now, and we're toying around. We're just asking Claude to follow the shipping lanes in the strait, and there's actually data. So, but we only started doing it yesterday, so I
so
can't.
you're deep into it.
The other thing is, I also want to see the data on drones. I mean, it's fine for the president to declare that we're almost there, almost mission accomplished, but that's not going to be the case unless the drones stop flying into the neighbors, into the straits, into aiming at our ships.
In ending March 31, I believe it's another end of the quarter, if we can get there. And then into April with JP Morgan reporting, and off we go to the Q1 earnings season. What does Ed Yardeni see with a broader sense of use of cash?
Well, right now the earnings story has been phenomenally strong, and that's really what's been driving the market. The valuation multiple, got up to about 22. It's come down because of this pullback so far, which is it's not a correction yet, but I think it has that.
Why are we? This is too important. Since when are we hysterical about a Yardeni pullback that, as you state, is not a correction as we learned it in school?
Well, a pullback is a drop that isn't a correction. A correction is 10 to 20% decline. A bear market is more than 20%. I happen to think that there is a 35% probability of things going badly, and that would lead to a correction of 10 to 15%. I'm actually amazed by the resilience of the not just the economy, but the stock market. The stock market wants to believe that all will be well very, very shortly. We saw this amazing reversal also in the price of oil, as though, what were we thinking? There's plenty of oil out there. Well, there is plenty of oil out there. We just got to get to it.
Damien, quick one in here, quick one.
Well, I mean, Ed, it sounds like you're talking about just cleaner positions, right? And I mean, if this is really what this amounts to, where you basically are giving a lot of, risky investors the opportunity to kind of, pare back their positions and clean them, so to speak, does that mean we might look for another leg higher into the, second half of this year? And can we really even see that?
Well, I haven't given up on 7,700 by the end of the year.
Okay.
And so, yeah, I'm arguing that it's not necessarily going to be a few more days of the war, but it could be a few more weeks. And that, again, I have this tendency to look at sell-offs as buying opportunities rather than reasons to panic.
Thank you for coming in.
My pleasure, always.
I can't say enough about it. Folks, I enthusiastically support the work of Dr. Yardeni. We protect the copyright of all of our guests. Please don't call us to get his research. Go to Yardeni Research for his fabulous daily synthesis of economics.